Today we're going to cover the three key financial statements. Financial statements indicate a business's financial health and stability over the fiscal year. The three financial statements include the balance sheet, the income statement, and the statement of cash flow. A balance sheet reports the firm's financial condition on a specific date. An income statement summarizes revenue, cost of goods, and expenses, which includes taxes, for a specific period. It also indicates the firm's profit or loss during that period. A statement of cash flow provides a summary of money coming into and going out of the firm. It tracks cash receipts and cash payments. The balance sheet indicates a firm's financial condition at a specific point in time. A balance sheet breaks down three different areas, including assets, liability, and owner's equity. Assets can be further broken down into three sections, including current, fixed, and intangible assets. Liabilities can be broken down into current and long-term, and lastly, there's owner's equity. So, what does current assets include? Items that can be converted to cash within 1 year. This would be cash, accounts receivable, any inventory, and then fixed assets, which are the long-term assets, are more permanent structures. They include things such as land that you own, buildings, equipment. These items would take a lot longer to be converted into cash. Intangible assets are also long-term, but they have no physical form and a lot of value. Some examples might be a patent, trademark, or copyright. To break this down, let's give a few examples. Let's say you own a shoe company. Your current assets would be the money that you've received from customers who have purchased your shoes. It would also be the money owed by customers who have received the goods but haven't yet paid. And in addition to this, inventory. So the shoes that you have in stock that you have not yet sold. Fixed assets would be your stores, your factories, and the equipment that you have to make the shoes. For intangible assets, you might have a patent on a certain material that you created for your shoes. Next, we have liabilities and owner's equity. There are current liabilities and long-term liabilities. Current liabilities are payments that your firm owes that are due within less than a year, and long-term liabilities include payments that are due in longer than a year. Owner's equity is the value of what stockholders own in a firm. This is also called stockholders' equity. Going back to the shoe store example, for your current liabilities, you'll likely have accounts payable. For example, if you've purchased materials to make your shoes, or if you're purchasing your shoes outright from another organization, you'll likely pay for that with credit, and then you'll need to pay them back. Notes payable can be short-term or long-term liabilities. This could be if the shoe company purchased a loan from a bank to expand, to purchase more equipment, and the business promises to repay that within a certain period of time, whether it's 1 year, 5 years, 20 years. It all depends on what they're purchasing. For long-term liabilities, you have bonds payable, which includes money lent to the firm that they need to pay back. Owner's equity is the amount of the business that belongs to the owners, and then subtract any liabilities that the business owes. There's also retained earnings, which is the accumulated earnings from a firm's profitable operations that were reinvested into the business and not paid out to stockholders in dividends. Now we'll move on to the income statement. The income statement takes into account revenues, cost of goods sold, gross profit, operating expenses, and net income after taxes. Revenue is the value of what's received from goods sold, services rendered, and other financial services. So for the shoe company, the revenue would include all of the money made by the shoes being sold. The cost of goods sold includes the cost of the merchandise sold and the cost of the raw materials or parts used for producing items for resale. So with the shoe company, it would include all the materials used to make the shoes, or if you're purchasing the shoes whole, then the cost of purchasing the shoes. Then, to find the gross profit, you take the revenue and subtract the cost of goods sold. This indicates how much the firm actually gained by selling the product. Next, you have operating expenses, which is the cost incurred in operating a business. So from this area, you would take out salaries, advertising costs, supplies, insurance, depreciation, rent, electricity, and any other operating expenses unique to your business. And lastly, you get your net income, which is a profit or loss over a specific period of time after subtracting all costs and expenses, including taxes. Next, we have the third financial statement, which is the statement of cash flow. The statement of cash flow reports cash receipts and disbursements related to operations, investments, and financing. The cash flow from operating activities would include things such as sales, commission, fees, interest, salaries, inventories, operating expenses, interest, and taxes. Basically, for the operations, it includes any cash transactions associated with running the business. Next, we have cash flow for investments, and this would include cash flow generated from a purchase or sale of long-term operational assets, if the company is investing in other companies, and if it has any lending activities. So for the shoe company, let's say that the factory has a piece of shoe machinery that is slightly outdated, and they decide to sell it and purchase a new machine. The money from the sale of the old machinery and then the money used to purchase the new machinery would go under this section. So if the shoe company chose to invest in some other companies, then any profits or losses from those investments would be listed here as well. And lastly, you have the cash flow from financing activities, and this would include inflows and outflows associated with the company's own equity transactions and borrowing activities. So simply put, the cash flow statement is a way to show the amount of cash coming in and the cash going out of a business. Today, we did a quick overview of the three key financial statements, including the balance sheet, the income statement, and the statement of cash flow, and these are so important to the overall success of a business. Thanks for watching.
Created using Powtoon.